Have you ever wondered how to invest in the Indian stock market? Well, you're not alone. The Indian stock market, one of the world's most dynamic financial ecosystems, presents an exciting opportunity for investors. It's a bustling marketplace where companies trade their shares and investors, both big and small, buy and sell these shares. The magic of this market lies in its ability to generate wealth over time, turning small investments into substantial returns. But it's not just about making money, it's a reflection of India's economic health, its growth, and its potential. It's a platform where billion-dollar corporations and startups alike vie for investor attention. The Indian stock market, comprising key participants like SEBI, NSE, BSE, and the role of stock exchanges, plays a pivotal role in the country's financial landscape. Now that we've painted a broad picture, let's dive into the specifics. To get started in the Indian stock market, it's important to understand a few key steps. First off, you'll need to open a trading account and a demat account. The trading account allows you to buy and sell shares, while the demat account holds these shares in a digital format. Next, you'll want to familiarize yourself with some basic stock market jargon. Terms such as IPO, which stands for Initial Public Offering, Nifty, which refers to the National Stock Exchange 50, and Sensex, the benchmark index of the Bombay Stock Exchange, will become a part of your everyday language. Lastly, choosing a stockbroker is a crucial step. Look for a broker who offers a good mix of affordability, customer service, and quality research. And there you have it. With these first steps out of the way, you're ready to delve deeper into the world of stock investing. Fundamental analysis is a key aspect of informed stock investing. It's all about examining the intrinsic value of a company's stock by analyzing its financial statements. These can include the balance sheet, which provides a snapshot of a company's financial health, and the income statement, which reveals the company's profitability. Now, how do we evaluate these financials? This is where key financial ratios come into play. For instance, the price-to-earnings ratio, or PE ratio, compares a company's stock price to its earnings per share, providing insights into the stock's relative value. The return on equity, or ROE, measures a company's profitability by revealing how much profit a company generates with the money shareholders have invested. These ratios and others are crucial tools for evaluating a company's financial health and growth prospects. When used wisely, they can help investors make informed decisions about which stocks to buy, hold, or sell. With a solid understanding of fundamental analysis, you're well on your way to making informed investment decisions. While fundamental analysis is important, technical analysis also plays a crucial role. Now, let's dive into the world of charts and indicators. Charts, like candlestick charts, are visual representations of price movements. They can reveal patterns that help predict future price movements. Candlestick charts in particular show the opening, closing, high and low prices for a given period. Next, let's talk about technical indicators. These are mathematical calculations based on a security's price and volume. Two common indicators are moving averages and the relative strength index, or RSI. Moving averages smooth out price data to identify trends over time, while the RSI measures the speed and change of price movements. These tools are not fortune tellers, but they can provide valuable insights. For instance, if a stock's price crosses above its moving average, it could be a bullish signal. On the other hand, an overbought RSI might suggest a potential price drop. Technical analysis will help you time your trades and maximize your returns. Investing in the stock market isn't without risks, but effective risk management strategies can help. When we talk about risk management, one key tool that investors use is a stop-loss order. This is an order placed with a broker to sell a security when it reaches a certain price, thereby limiting the investor's loss on a security's position. Another essential risk management technique is diversification. It's an investment strategy that mixes a wide variety of investments within a portfolio. The rationale behind this is that a portfolio of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. In addition to risk management, successful investors often follow certain trading strategies. These may include value investing, where one seeks stocks that appear to be undervalued in price; growth investing, where focus is on companies that show above-average growth; and day trading, where stocks are bought and sold within a single day. By managing risks and employing sound strategies, you can navigate the ups and downs of the stock market. Staying updated with market trends and news is crucial for every investor. In the dynamic world of stock market investing, information is power. But how do you stay informed? There are several resources at your disposal. Financial newspapers, business news channels, and online portals are a treasure trove of real-time data and analysis. The impact of global events on Indian markets cannot be overstated. International economic policies, geopolitical tensions, global commodity prices, these all have a ripple effect on our domestic market. By keeping an eye on these global events, you can anticipate potential market movements. However, simply consuming news isn't enough. It's important to analyze how this information can impact your investment decisions. Does a change in government policy signal growth for a particular sector? Does a drop in oil prices affect the profitability of aviation stocks? By asking these questions, you can use news to your advantage. With a keen eye on the market trends and news, you can make informed investment decisions. Every investor makes mistakes, but learning from them is what separates successful investors from the rest. Now let's discuss some of the most common pitfalls you'd want to avoid. Firstly, there's the herd mentality. It's easy to get swept up in the tide of public opinion, but remember, the majority isn't always right. Make your investment decisions based on solid research, not just because everyone else is doing it. Secondly, timing the market. It's a tempting idea, trying to buy low and sell high. But even the most seasoned investors struggle with this. Instead, focus on the long-term potential of your investments. Lastly, let's talk about perspective. Investing isn't a get-rich-quick scheme. It takes patience and perseverance. Keep a long-term perspective and don't let short-term market fluctuations derail your investment strategy. By avoiding these common mistakes, you can increase your chances of success in the stock market.